This is a man who multiplied his account by 2,500x over a 10-year period. He started as a commodity research analyst and then fully transitioned into a full-time trader. Michael Marcus, a market wizard, started trading the soybean and corn market after being introduced to it in his university by a mutual friend named John, and as all beginners do, lost money in his first few trades because of the lack of knowledge and strategy, essentially gambling his whole capital. His first 8 trades, 5 with John and 3 on his own, were all losers. Overall, he lacked knowledge about trading commodities, contract sizing, and all the costs that are associated with trading. Educating yourself in any field of endeavor is crucial, and every successful trader knows that you must treat trading like a business. And as with any business, you need a plan and you need metrics to constantly be monitoring and keeping track of. After constantly losing money, he decided to educate himself and read Chester Keltner's books and subscribed to his market letters. With that, he started to see some success trading in wheat and corn based on Keltner's recommendations. In terms of taking recommendations and signals as a beginner trader, I highly advise against it. You should always understand why a trade should be taken, and if you are going to listen to someone, you need to make sure that they're vetted, they're consistently profitable, and they're actually knowledgeable about the things they're talking about. You need to understand their thesis, their stop losses, their strategies, their psychology while they're in the trade, and all the emotions that they're feeling. If you're just taking signals from some random influencer that you found, sure, you may make some money in the beginning, but overall, you have no skin in the game, no experience in the game, and when you try to trade on your own, you'll have no confidence in any of your setups. After educating himself, Marcus accumulated $30,000 in profit, which is a significant amount of money during that period of time. He decided to make a bold move and borrow $20,000 from his mother, raising his total trading capital to $50,000. Marcus took the risk and bet everything on a blight theory in the grains market, believing that a blight would attack the corn crops. With a blight attacking the corn crops, that would cause corn to be in a shortage, which would mean that in order to make money, you would long corn because there's a shortage of it. The market initially held steady, but after a negative Wall Street Journal article, the corn market went limit down, causing trading to cease. So there's several mistakes to unpack here. First, you should never borrow money or take leverage when you're placing a trade. If you don't have enough money, just go get a job and start saving up while monitoring and looking at the market. Next, don't ever bet your whole account size just on one trade or on one thesis. You have to have enough capital to stay in the game for the long term and learn from your mistakes to grow as a trader. You see, everything in life is a numbers game, and the one who puts in more reps has the most chance and higher probability of succeeding. Who do you think is going to be a better trader? Someone who's only taken 50 trades or the other person who's taken 1,000 trades? Finally, we all know that when your thesis proves wrong, you need to cut your losses immediately and as quickly as possible. Despite needing to cut his losses and exit, Marcus held on to his trade, paralyzed by what he was seeing. He was smoking on hopium, hoping that the market will come back, which of course never did. He lost $30,000 of his trading capital, plus the $12,000 he borrowed from his mother. Down and out, Marcus decided to find a job. He landed a commodity research analyst position at Reynolds Securities and met Ed Seykota, who introduced him to key trading principles. Ed taught him principles such as cutting your losses quickly and the importance of writing your winners. The lesson here is that every time he levels up, it's because he meets a mentor and is constantly educating himself and being open-minded. There are certain things you can be stubborn with, but in the game of trading, you cannot be stubborn in your own ways and in your own head whatsoever. If you're losing money trading, that means that there's something wrong either with your psychology or your strategy. With that being said, I will be offering one-on-one mentorships soon, so be on the lookout for that. Ed was primarily a trend follower, and that was actually pretty contrarian back then. As when the market kept sliding down, most would say it's too low and it has to bounce. Well, Ed would stay short until the trend changed and the price action showed him that the reversal was happening. Following the trend and letting the price action dictate your actions are key trading principles that have been relevant back then and even to this day. If the market is trading up or down, I don't like trading against it. Instead, I wait for a pullback going opposite of the trend that's approaching a key zone or key level. Then I try to enter a trade along with a trend with a tight risk. That way you're not chasing a trend and you have good risk management. Despite Ed being there and mentoring him, Marcus was still losing money, deeply frustrated. The industry of trading is extremely brutal and it will take a physical and mental toll on you. You have to learn how to cope with it and have some sort of a balance going on. You can't be getting too frustrated and in your head with your trading losses, because over a long period of time you'll burn out, and it'll make you want to quit too soon. Michael Marcus stated in the interview that he wasn't being patient and waiting for a clearly defined trade take. At this point, he could have just followed Ed's trades and he would have been profitable, but he just couldn't bring himself to do it. So at this point, he's experienced enough to know that simply just taking another person's trades isn't a good way to make money over the long term, because you need to hone in on your own skill and your own craft and be self-sufficient when it comes to trading. Another point here is to be highly selective of your trades and to be patient. You have to wait for your setup to happen or you'll just be burning money. So once again, being dead broke and hitting rock bottom, Marcus was deeply frustrated, but he hadn't lost hope. He was stubbornly confident, saved $700 and opened a joint account with a friend. He grew it up to $12,000 trading plywood for the upside in just a few months. Anticipating the same result with a lumber shortage, remember, supply and demand, so when there's a shortage of lumber, you're expecting lumber prices to go up because there's a shortage. He bet everything on one trade for the long side as a sympathy play. That is, since they're both wood products, if plywood went from $110 to $200, which it did, then lumber should also go up. However, the government announced a crackdown on speculators, leading to a crash in the lumber market. Marcus barely hung on to this position as the market stabilized just above the point of wiping him out that was lasting about a brutal 2 weeks. So for 2 weeks, he was watching the market go against him, and his $12,000 turned into $4,000. But still with $4,000 left, he held on to his position. And surprisingly, holding on to his position, he grew that $4,000 back into $24,000 by the end of the year. In next year, 1973, the government lifted price controls, leading to a commodities boom, and his lesson from Seikoda about staying and holding the major trends paid off, turning his $24,000 now to $64,000. This is a lesson of the power of allowing winners to ride. And personally for me, this is a problem or aspect of my trading that I need to get better at. Sure, I am profitable and I am making money from the market, but if I was allowing my winners to ride a lot longer, I would definitely have way more money. The thing is, I am a scalper at heart, so I like to scalp trades, and I also like to cut my losses very quickly. And so, it's a double-edged sword with that. And so, it's just a constant balance and a continual strive for perfection. So in the mid-1970s, it was also an inflationary market, and so going long was the move, as everything was going up. Even in an inflationary market with the market going up, Marcus still managed to make a mistake and took profits way too early. As soybeans were pushing up and limiting up for 12 consecutive days, he took his profits way too early. It said in the interview that his FOMO, or fear of missing out, caused him so much mental anguish that he decided to take some tranquilizers and Thorazine to dull his mental anguish. I mean, that's a different level of FOMO, and I guess you can argue that missing out on a winning trade is as bad or as painful as losing on a trade. I mean, personally, I would never, take any substances to, relieve myself because of a frustrating problem about trading. But I guess this just shows kind of his dedication to the craft and I guess his obsessive nature about it. Is it healthy? Is it psychologically and mentally good for you? Probably not. But I guess this is why he's made multi-millions from the game. And yeah, I personally look at trading as a game and don't like to get too personal with it. Yeah, I take trading very seriously and treat it like a business and track everything that I do. But when I'm not in front of the market, I like to enjoy life, go outside, because there's a lot more to life than just trading, and you don't want that. And you don't want trading to occupy your mental bandwidth when you're off the market, because you'll essentially be thinking about stocks and the economy and the market and what you should have done, your whole life. So definitely try to find a balance. Marcus eventually qualified as a floor trader with a net worth exceeding $100,000 and learned to gauge price movement by the intensity of the voices on the trading floor. He used intraday points to take larger positions with close stops. But I think at this point, even being on the floor as a trader, I don't think he was making too much money, or if he was, it was an insignificant amount. Yeah, that's kind of what I remember from reading the book. At this point in time, with the market being choppier, with more pullbacks, what he recommends is cutting down the number of trades. He states that the best trades have fundamentals, technicals, and market tone all in your favor. I mean, I guess from reading these books, the market was a lot more smoother back then. It didn't have as much pullbacks. And when a trend happened, it would push through certain zones and resistance levels, a lot more easier. But to me, that's not an excuse. You still have to adapt. with every market cycle, and hone in on your strategy. If there's more pullbacks, you wait for it to push through a resistance zone. If there happens to be more pullbacks in a certain market cycle, what you have to do is be patient, wait for the trade or wait for the stock to break through a resistance level and then pull back to the levels so that you can enter a trade with a tight stop and ride the trend. He also stated that he would enter 5 to 6 times his original position sizes on other trades with his most optimal trades. Sizing in when you have a higher conviction on your trade is crucial and key to being successful and profitable over the long term. If it's an A+ setup and it's a setup that you've been back testing and you have really high conviction on, you shouldn't place your whole account size on it, but you need to be able to put some disproportionate risk on that trade and really take advantage of the opportunity when it presents itself. This of course comes with experience, and if you're a beginner trader, then I would advise just taking every trade with the same position size. As you gain more experience, you start to see certain trades with higher probabilities, and that's when you size in higher. Being a floor trader, he joined Commodities Corporation in 1974 and turned $30,000 into $80 million with the company account. So all of this primarily came from the Market Wizards book by Jack Schwager, where he interviews the top traders in America, and he was the first interviewee. So yeah, just looking at his career, his trading experiences, some of his advice, it's definitely inspirational, just seeing the evolution and the fact that he turned all his challenges into lessons. I think that's a good way to approach life. He blew up his account several times, lost the money that his mother gave him, but still persevered through it all. If he had quit right when he blew up his account, he would have gone back to his old corporate job and never realized his fullest potential. That's the importance of persevering, being resilient, never giving up, and never quitting. If you stop or take a U-turn away from the road to your goals, then that's a guaranteed way for you to fail and never reach your goals. But if you keep on going, don't ever stop learning, and stay focused day in and day out, it's just a matter of time before you start to see some of the fruits of your hard work. So keep pushing.